Welcome to PyUncut, where we break down the biggest trends shaping technology, business, and the global economy in a way that's simple, clear, and meaningful. Today's story is about a major shift in big tech. For years, companies like Amazon, Google, Meta, and Microsoft were on a massive hiring spree. They were adding tens of thousands of employees every year, building teams for cloud computing, e-commerce, social media, and artificial intelligence. It felt like the growth would never stop. But now, that era is over. The hiring boom that defined big tech over the past decade has slowed down dramatically, and in many cases, it has completely reversed. The latest workforce data shows a very different picture of the tech industry today, one that investors, employees, and even governments need to understand. Let's start by going back to what happened between 2020 and 2022. During the pandemic, digital adoption exploded. People were shopping online, working remotely, streaming content, and relying on cloud services more than ever before. Tech companies saw unprecedented demand, and they responded by hiring aggressively. Amazon nearly doubled its workforce. Meta expanded rapidly to build its metaverse vision. Google and Microsoft hired across cloud, AI, and enterprise services. At that time, hiring was seen as a signal of strength. More employees meant more innovation, more products, and more growth. But here is the key turning point. As the world reopened and economic conditions tightened, demand started to normalize. At the same time, inflation rose, interest rates increased, and investors began demanding profitability instead of just growth. Suddenly, big tech companies realized they had overhired, and that realization triggered one of the biggest waves of layoffs the industry has ever seen. Thousands of employees were let go across major tech firms. Entire divisions were restructured. Hiring freezes became common, and the message from leadership was clear. Efficiency is now more important than expansion. If we look at workforce trends today, the numbers tell a powerful story. Headcount growth has flattened across most big tech companies. In some cases, total employee numbers have actually declined compared to their peak levels. The explosive hiring curve that once defined the industry has turned into a plateau, and in some places, a downward slope. This is not just a temporary slowdown. It reflects a deeper shift in how tech companies operate. One of the biggest reasons behind this change is the rise of artificial intelligence. AI is allowing companies to do more with fewer people. Tasks that once required large teams can now be automated or assisted by AI systems. From coding and customer support to data analysis and content creation, productivity per employee is increasing rapidly. This creates a new dynamic. Instead of hiring more employees to scale, companies are investing in technology to scale. The focus has shifted from workforce expansion to efficiency and output. Another important factor is cost discipline. During the low interest rate era, companies could afford to spend heavily on hiring because capital was cheap. But in a higher interest rate environment, every dollar matters. Investors are closely watching margins, profitability, and return on investment. As a result, tech companies are becoming more selective about hiring. They are focusing on high-impact roles, especially in areas like AI, cybersecurity, and cloud infrastructure, while reducing or eliminating roles that are less critical. This leads us to a very important insight. The slowdown in hiring does not mean that opportunities in tech are disappearing. It means that the nature of those opportunities is changing. For example, while general hiring has slowed, demand for AI engineers, machine learning experts, and data scientists is still strong. Companies are also hiring in specialized areas like chip design, robotics, and advanced cloud systems. So the workforce is not shrinking uniformly, it is being reshaped. Now let's talk about what this means for the global economy. Big tech has been one of the biggest drivers of job creation over the past decade. When these companies slow down hiring, it has ripple effects across multiple industries. Startups, contractors, and even local economies that depend on tech jobs can feel the impact. At the same time, increased efficiency in tech can boost productivity across the broader economy. AI-driven tools can help businesses in healthcare, finance, manufacturing, and education become more efficient and innovative. So, there is a balance here. On one side, fewer jobs in traditional tech roles. On the other side, new opportunities emerging in AI and advanced technologies. For investors, this shift is extremely important. A few years ago, the market rewarded companies for rapid growth and expansion. Today, the focus has shifted to profitability and efficiency. Companies that can generate higher output with fewer resources are being valued more highly. This is why we are seeing strong performance in companies that are leading in AI and automation. Investors are betting that these companies will define the next phase of technological growth. However, there are also risks. If companies cut too aggressively, they may slow down innovation. Talent is still a critical asset in tech, and losing skilled employees can impact long-term growth. There is also the risk that over-reliance on automation could create new challenges, especially in areas where human judgment is essential. So what should viewers take away from all of this? First, the big tech hiring boom is over, and it is unlikely to return in the same form. The industry has matured, and companies are now focusing on efficiency rather than expansion. Second, artificial intelligence is fundamentally changing how companies operate. It is not just a new technology. It is a force that is reshaping the workforce itself. Third, opportunities in tech are not disappearing, but they are becoming more specialized. Skills in AI, data, and advanced technologies are becoming increasingly valuable. And finally, this shift reflects a broader change in the global economy. We are moving from a phase of rapid expansion to a phase of optimization and productivity. In conclusion, the story of big tech today is not about decline. It is about transformation. The industry is evolving from a model driven by hiring and scale to one driven by efficiency and intelligence. Companies are learning to do more with less, and that is redefining what growth looks like in the digital age. For employees, this means adapting to new skill requirements. For investors, it means identifying companies that can thrive in this new environment. And for the global economy, it marks the beginning of a new chapter in the relationship between technology and work. This is not the end of growth in tech. It is the beginning of a smarter, more efficient era. And that is the story you need to understand. Thank you for listening to PyUncut.